The reason why diversification doesn't break the fundamental rule of finance is that there's some minimum level of risk that simply can't be diversified away. In other words, no matter how I combine my portfolios, no matter how well I diversify, no matter how intelligently I select all my assets so that they are perfectly opposing each other, there is some risk that just can't be diversified. No matter what I buy on the world, no matter what asset I owned in the world, it didn't stop that asset from being affected by the systematic risk of a global pandemic. Just doesn't happen. Every economy, every company took a major nosedive because we shuttered the entire world economy. There isn't an asset that I could have purchased that would have avoided that kind of risk. There are some assets that are doing better than others, right? Certainly delivery companies, Amazon, and things like that are better performing in this kind of crisis because we're shipping things instead of going out to buy things. But they still took major hits, right? They still had negative returns for the most of the past couple months, just like the rest of the stock market. So no matter what I can do, no matter what I can buy, at this point in time, I currently cannot avoid the risk of a systematic, global systematic risk, right? Like a pandemic, like a war, like a recession or a depression. These are things that no matter what I have, no matter how well diversified I am, I can't avoid. Right? Now, if we ever get to the point where we are a galactic civilization, then we could diversify into Mars or Jupiter or Uranus or whatever, and then we could talk about avoiding global systematic risk. But then, of course, we'd just be in a bigger world now, right? So we'd have galactic systematic risk or solar system risk or whatever that might be and whatever that might look like, right? Ultimately, there will always come a point where some risks are unavoidable, right? And that is what we mean. And that is what's going to bring us back into line with our fundamental rule that risk and return must trade off. It's just that we started with a measure of risk that was inappropriate. It was too big. We started with a measure of total risk, whereas it turns out because forming a portfolio can get rid of a type of total risk or a portion of total risk, we weren't actually relating return with the right kind of risk. So let's see here in this graph just how easily and how powerfully diversifying a portfolio can get rid of risk. Now, here, the way that I made this graph is I formed random portfolios of completely random stocks of different size. Right? So on the bottom, on the x-axis, you can see the size of the portfolio, from 1 stock in the portfolio to 10 stocks in the portfolio to 30 to 1,000 stocks in the portfolio. And I formed as many different random portfolios as you can. So the portfolios of stock size 10 are completely randomly chosen, and there's 10,000 of those random portfolios. And then I looked at the average annual standard deviation, so total risk for the portfolios of that size. So of the 1,000 portfolios of 10 different random stocks, the average standard deviation was 23.9%. But for the single individual assets in the market, a single stock, right? You can see that the average annual risk was 49.2%. So that's a ton of risk for holding an individual stock. There's a lot of, you are bearing all of the unique risk of that asset and all of the systematic risk of the market. And so you're bearing a considerable amount of risk, right? 49%. Remember what that means, standard deviation. It means that based on what our expected return is, we think that there's a 68% chance that our actual return will be somewhere between +1 standard deviation and -1 standard deviation. But here, for the average individual stock, the standard deviation is 50%. So that means our actual return will be somewhere between plus 50 and minus 50 of our expected return, which is a huge range. It gives us absolutely no guidance on what we think will actually happen. It's also a ton of risk. There's a lot of potential downside there. Portfolio diversification, even completely naive, unintelligent, didn't think about it at all, completely random diversification of just combining 10 stocks into a portfolio cuts that risk in half. We go from 49.2 to 23.9% standard deviation. Right? And where does all of that disappearing risk come from? It comes from all of the unique risk of those 10 individual assets. I cut out the unique risk by forming a portfolio, and even a random one does a decent job at it. Right? And if I form a portfolio even of, say, size 30 or size 40, again, completely random, the average risk drops down to close to 20%. Right? And once I get to about 40 to 1,000, I have reduced, no matter what, at that point, I have reduced a considerable amount of risk. But once I'm at 1,000 stocks, I'm essentially owning one share of every stock in the entire market. And that means that I am well diversified no matter how intelligently I am. Doesn't matter. If you buy one of everything, you're completely diversified. Right? And again, what did I get rid of? Well, I didn't get rid of anything that affects every stock in the market, because all of the things in my portfolio are still stocks. What I did do, though, is get rid of all of their unique risks. And all I am left with now in the portfolio is systematic risk. And this now is how we sort of need to rethink, right? We need to rethink how this applies to our fundamental rule. Because we first talked about the fundamental rule in terms of standard deviation, which is total risk. But now we're saying a simple random portfolio of 30 stocks gets rid of almost all of the unique risk, and we're only left with systematic risk. And that means that we now have maybe a better measure, a more appropriate measure of risk and return. Right? So because I can get rid of unique risk, it is sometimes called diversifiable risk. Right? So it has a lot of names: unsystematic, unique, asset specific, diversifiable. All of those things refer to the same portion, which is the unique risk for individual firms that we can diversify by forming portfolios. Right? The risk that we're left with, right, is the systematic portion of risk. Right? And that, now that we know that total risk has this diversifiable portion and this non-diversifiable portion, we want a better measure of the true risk that you face when you own assets, and that true risk is the systematic portion. In other words, what I want now is I want to measure, much like standard deviation, that represents a stock's or an asset's exposure to systematic risk. And again, this is going to be different for every firm. Even though every firm is affected by systematic risk, the degree to which every firm is affected will be different, right? Amazon is doing better than, say, Target during the pandemic, or it's certainly doing better than, say, American Airlines during the pandemic, because each of those firms' exposure to this kind of systematic risk is different. Amazon's a delivery company. Airlines are not flying anyone anywhere at all right now. So the exposure to systematic risk is going to be different. So I want to create a measure, much like standard deviation, that allows me to characterize a firm's exposure to systematic risk, because that's going to be the only risk that matters when we try to calculate expected return. Okay? So the fundamental rule of finance isn't broken. Risk and return trade off one for one. It just happens that standard deviation isn't the appropriate measure for the risk that we're talking about when we're talking about that rule. Systematic risk is the appropriate risk to talk about. And if we can come up with a measure of systematic risk, then we can start to use that to move forward. Okay? So the measure of systematic risk that we're going to use, and it's not something that we'll calculate in this class, is called beta. So ideally, it's something that you've heard before. Beta is a pretty famous term in the market, and it's famous precisely because beta is the measure of systematic risk for an asset or a portfolio. Remember, portfolios are assets that contain other assets, right? Compared to the market, right? So beta is how we understand our fundamental rule of finance. It's not just risk and return trade-off. It's systematic risk and return trade-off, right? Because all the other risk, all the non-systematic unique risk, I can diversify away by forming a random portfolio of enough stocks. And so because of that, I shouldn't be rewarded for holding random risk, right? Just like I'm not rewarded for taking unnecessary risks in life, right? I don't have more fun when I go skydiving if I take a parachute that has a frayed strap and might break when I pull the cord, right? You don't have more fun because you took risk you didn't need to, right? In the financial world, I don't have more return because I took risk I didn't need to. If I form a random portfolio of 40 stocks, I'm pretty well diversified in the stock market. Because of that, and because of how easy it is, I shouldn't expect to get extra return for bearing that. All I have is more risk, right? So that's why beta is so well known. It's so important, because this is the measure of risk that actually helps to generate return. And the formula for beta is pretty straightforward. Beta is the percentage change in the asset's return given the percentage change in the market return.